Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino, certified financial planner and chartered investment manager. I'm a financial planner with TC Wealth Management and Visa Wealth. For more details or to send in your questions, check out the show notes at treybino.ca/podcast. If you want to learn more about me, start with episodes 1 and 2. So let's get into the 21st episode. So this episode is on TFSA. So we did one a little while ago, a few weeks ago on RRSPs, and then one prior to that on RDSPs. So this one is on TFSAs. What does TFSA stand for?
TFSA stands for tax-free savings account.
Yeah, and I think it's the worst name. Why do you think I hate the name?
Savings account?
Yeah, just categorically get rid of it. It's very annoying.
What would you call it instead?
I don't know, tax-free investment account is better.
Yeah, I guess. It's just because people think saving.
Yeah, people assume it should be used as a
TFFA?
Yeah, tax-free.
Financial?
TFIA.
TFIA.
Tax-free investment account. I don't know.
People always used to call it TSFA when I worked as a teller.
Yeah, I still get it mixed
up. Yeah. Too close.
Yeah. But it's the reason it is not a savings account. It is a investment account. It is basically fundamentally you put money into a TFSA, and any growth on that money, any income on that money, you don't pay taxes on unless you do. So there are a few pitfalls. Unlike other episodes where I've basically glossed over anything high level, there are a few things that are a little bit more advanced that I do want to touch on. So we'll touch on a little bit about taxes, but I want to quickly compare it to an RRSP.
Yep.
What's the difference?
Okay. The difference is an RRSP defers tax into a different year. So you still have to pay tax at some point on the growth.
Yeah.
A tax-free savings account, there's no tax on the growth regardless of when you pull it out. Is that, I feel like there's probably more. But
there's lots, but yeah, that's the big one.
That's the big thing I know because I had to make a chart about it at one point.
For Cornerstone?
Yeah. Oh, I don't know if you're supposed to. Can we say that?
No, it's fine.
Okay.
Okay, so you're right. So fundamentally, they're very similar. With the TFSA, you're putting in after-tax dollars. What that means, I mentioned in the RSP episode that if somebody isn't great with money, I prefer them to be investing and saving within a TFSA. If you're only going to put away $1,000 into something, and that's all you're going to put away, then it should be the TFSA, because at least you don't have to pay tax when you put it out. Versus with an RSP, you are paying tax. So you're not really putting $100 away. You're putting in
like $80 or whatever.
Yeah, right.
Yeah.
In theory.
In theory, yeah.
Right. Or should I say in practice? I don't know.
That's
what you're doing.
Yeah, you're right, I think.
Yeah, that's what you're doing. So the TFSA is an incredible tool. There is limits on what you can put in there. Do you know what the limit was for this year?
I think the last time I had to check it, it was like $2,500 or something like that.
$2,500?
Isn't that the yearly?
Never been that low.
Oh, sorry. Maybe I'm thinking of something that's $5,000, $5,500.
It was $5,000 for a long time. This year it was $7,000.
Wow.
Yeah, so it goes up according to inflation. So since 2009, I'd say 2009. It was $5,000, and it's that same $5,000 adjusted to inflation.
That's horrible.
Yeah.
To hear, to be honest.
Yeah.
Wow.
Yeah. So in total, you have $102,000 of room if you was,
starting fresh.
You was over 18 in 2009, and you have all the room, never contributed, never done nothing. You have $102,000, and that $102,000 is money that you can put in and take out without any penalty. There are some restrictions. So if you take money out of a TFSA, you don't get that contribution room back until the following year.
Yes.
So the following January 1st.
Yep.
So if I take it out all on December 30th and I can put it back in January 1st of the following year. If I take it out on January 3rd, I have to wait the full year until January 1st of the following year to be able to put the money back in. So it's not a time thing, it's a calendar year thing.
Okay.
Okay.
Is that that's a tax year then thing?
A calendar year.
Oh, okay.
Yeah. Just, I guess it would be tax year, but I'm cautious with tax years. I work with a lot of corporations and they have different tax years, right? You kind of set your own tax year. So
yeah.
Calendar year.
Calendar year. Okay.
Yeah. And what can go inside of a TFSA?
So cash can go inside a TFSA, but don't do it. That's what Trey's going to say next.
Kind of. So
you can purchase investments within a TFSA.
Exactly. You can hold anything that you can hold outside of a TFSA in a non-registered account or in an RRSP inside of a TFSA, pretty much. There's the vast majority of things. Mm-hmm. So I want you to think of it as just one more tool, one more account in your repertoire.
Yeah.
Nothing fancy about it. The way you determine how that money is invested, you still do the same thing that I teach: invest to the right time frame, or 100% equity, either one of those, and you do exactly the same thing. No leaving it sitting there in cash doing nothing. No, none of that. The one thing I will say, the caveat to that, is I do tell people to put their emergency funds inside of the TFSA.
Oh.
Could you think of when I would recommend that? Like, no, that's very uncharacteristic.
Yeah,
yes, there is only one time, one instance I would ever recommend that.
I have no idea.
And that's if you have the room and nowhere else to put it. Like, if I have $30,000 in my emergency fund and I'm going to leave it in a savings account, like a high interest savings account, I would rather that high interest savings account be inside of my TFSA than outside of my TFSA if I can't fill up my TFSA anyway.
Okay. Yeah.
Yeah. So if you don't have enough saved to be maxing out your TFSA, then
because you regain that room all the time, right? So let's say, like, the TFSA. I'm gonna struggle with this, I think. But you take the money out, you get that room back eventually.
Yeah.
Versus the RRSP.
Yeah.
So it's like you might as well have that 30 grand sitting in your TFSA.
You can get the same rates and everything inside of a TFSA as outside of a TFSA. You might as well not pay tax on it.
Yeah, you might as well get the tax-free growth because, yeah, you're not losing room at any. If something changes and you're like, oh, I got a huge inheritance and now I want to max out my TFSA, it's like, great. You can.
At that point, as soon as you've maxed out your TFSA, then it changes. Then I do not want your emergency fund sitting inside of your TFSA, because the TFSA, the best use of it is long-term growth. Mm-hmm. In fact, when we do retirement planning and set out income and things like that for life, the TFSAs are pretty much the last thing you want to be touching. The last thing you want to be touching.
I yawned, yeah.
TFSAs are the last thing that you want to be touching. So it's kind of it sits in a weird spot where I like to make sure that the investments inside of it are fully accessible, but I also want it invested for the long term. So it should be a longest term money if you have lots of other things. So longest term money, if you're sitting there with, a $1.5, $2, $3 million retirement, you're probably not going to use your TFSAs. So therefore, it should be for long term. But at the same time, maybe you do want to splurge and buy something. Then the TFSAs are there as an option for you to access.
It's kind of an opportunity account a little bit in that way.
Yeah.
Like, because you can access it more and because you get the room back. I feel like that's honestly, I feel like that's a really good account.
They're huge. It's almost like a no downside type of account.
Yeah.
Where, like, what's the downside? You put, like, it's very often where I will, like, getting people to systematize their finances. I'll get people to funnel money into their TFSA, and then I'll pull it out to do RRSPs, or pull it out to do RESPs or RDSPs, or fund this or fund that, because it's like, well, there's no downside to us really doing it. The major downside comes from market movements. So let's say, here's a warning for a TFSA, is the room is very valuable, and it is more valuable than the tax savings. So there'll be oftentimes people will, great example recently is Cameco. So Cameco is a local company here, and they give their employees the option of buying shares within their TFSA, and the shares recently have jumped significantly in price. So a lot of individuals sitting on very high balances in their TFSAs, they absolutely should pull it out. You should pull it out. Doesn't mean they have to sell the stock. They should pull it out though, because that same stock, let's say it jumps to $200,000, that stock, jumps to $200,000. If they lose 10%, that's $20,000 of room. Versus even if that, and that's room forever.
Yeah.
The rest of their life, right, of growth that they can't get back. Versus if they had it in a non-registered account or outside of the TFSA, then maybe it jumps up, maybe it goes up another 20, let's say it jumps up 20%, right? So now they're sitting on a $40,000 gain. That means $20,000 extra income to them in their tax year if they sell it.
Yeah.
It's a one-off event, kind of move on from it. But a TFSA, the cost of losing money in a TFSA stays with you for life.
Wow.
So strongly recommend that when you are picking your investments within the TFSA, you don't pick anything speculative, because the consequences can be
big.
Yeah.
Yeah.
Another thing to caution is moving money from a non-registered account into a TFSA. So one thing you do not do is move a non-registered investment that is down into your TFSA. So let's say I buy Apple for $1,000 and it's now worth $500 in my non-registered account.
Yeah.
I do not move that $500 into the TFSA.
Okay.
Because you cannot claim the loss of that as if you sold it. So in a non-registered account, if you sell something at a loss, it offsets your gains, etc. So it's a capital loss. But if you move it into a TFSA, it doesn't work, basically.
It's not how it works.
Not how it works when you move an asset, because you haven't sold it. So
okay, yeah, gotcha.
You move it into a TFSA, you get nothing for that loss at all. Doesn't matter. So an important thing, there's a few traps that I guess that can be very easy to
if you're not sure about all these rules and stipulations, it's not a good idea to start. That's why the registered account things, I would never want to do it myself. Like, if you were not around, I can't be bothered to know all these rules.
Well, for the most part, people aren't doing that type of thing. The people that are doing that type of thing are the traders of the world that think. Often the people that would be doing that are the people that they'll come to me and they'll say, I can pick my own stocks. And it's like, great. That's 40% of what I do, is picking investments.
Yeah.
So it's like, it's all the tax and it's everything around financial planning and timing and taxes and looking ahead. And it's all of that stuff, the estate, that's my job. Yeah. The investment part is part of it.
Yeah.
And that's actually the reason I got into the industry, is because I enjoyed that part of it.
Yeah.
But where you add the most value and where you can truly help people on a consistent basis over and over and over again is the planning side of things.
Yeah.
But that aside, another thing that you need to be concerned about is, and this is more important if you have a non-registered account and a TFSA and lots of other accounts, is asset location. Mm-hmm. So within a TFSA, you will pay withholding tax, US withholding tax, on any US investments. That's really important because in a non-registered account, any withholding tax, it goes to your taxes and will reduce your taxes. There's a treaty between the US and Canada.
I feel like I've heard you talk about this before. It's familiar, but I'm like...
It's okay. But there's a treaty between the US and Canada. So in RRSPs, there is no withholding tax, right? Yeah. But within non-registered accounts and TFSAs, there are. Within a non-registered account, you get that back. You get a large chunk of that withholding tax, at least applied as a credit to your taxes. Mm-hmm. But inside of a TFSA, you do not. So that is a cost flat out.
Yeah.
So very often it will make sense for you to prioritize other types of income and avoid types of income where you are paying the tax inside of your TFSA, because the whole point of a TFSA is not tax. So there are reasons then to just something to keep in mind when you're selecting what is going inside of your TFSA.
Yeah, like I feel like that is all part of the planning process that you were talking about, where it's like you can't. Yeah, that's where the value is like knowing you're optimized in these ways, and you're basically you've read the rule book of the game, and you're like, okay, I know that you can kind of like go around this rule in a legal way, sort of thing. I don't know if that makes sense.
You just do it the way that they want you to do it.
Yeah,
honestly, and so you can. They make the rules so you can do it certain ways. You just make sure you take advantage of it.
Yeah.
Okay. The other thing I want to talk about was over contributing. Very, very easy to do. I would say categorically, don't have more than one TFSA.
Yeah.
It makes it such a pain for you to keep track of it. And I'm telling you, the CRA are ruthless. I did read an article somewhere that they had a judge rule against them or something like that as for the way that they, how predatory the RRSP,
or the
TFSA over contribution penalties are or something. It was in passing, so I'm not entirely sure what it was. But I read, and it was basically judge said, you're too aggressive. You need to have better processes, especially because they suck at giving us the room. I think this year we didn't even have the room come like May before it was updated on my CRA. Yeah.
Wow.
So another thing is you can go onto your my CRA account and see what your contribution room is. Part of the reason I say only just have one, it makes it a lot simpler for you to go in and see what has been reported and what hasn't been reported, because government might tell you a number. Doesn't matter if they're wrong. If they find out they're wrong in 2 years, they'll come back to you and say, you owe us over contribution. I think it was 2% a month or something. It is nuts. It is so expensive, the over contribution tax on it. So like the fee, don't even mess with it.
This is what kind of bugs me, because like you can walk into a bank, a credit union, whatever, and open a TFSA and put cash into it. And it's like, I just feel like that's a bad idea. And then the CRA are like letting people just have free reign over this, and then being like, you owe us money, even if we made the mistake.
Part of it is I felt so bad. I had this one client who went through a very traumatic period of time, and they came into some money, walked into a bank, one of the big 6 banks, and they have sales quotas. And basically they said, hey, you have this money sitting here, let's put it into a TFSA.
Yeah.
They were like, okay. They did it. Years later, they didn't ask me about it. I didn't, and this is where I feel bad, and this kind of shifted the way that I focus. It was just, it's still a touchy subject, but when people are going through very hard periods of time, you don't want to bombard them with, hey, make sure a financial checklist of things to do.
It's like, you've had a traumatic event. Okay, how many TFSAs do you have? Or like,
well, it's not just that. It's like they were my client, right? Like it was my responsibility. But I was like, okay, we will get to this stuff later. There is no focus on the other stuff right now, and we'll get back to this later. Yeah. But it didn't matter because they didn't really understand everything that we had done. And anyway, they'd already had them maxed out TFSAs. Yeah. They go in, so they've now over contributed by almost $100,000, and the government comes back. Fortunately, they wrote them a letter, and they got a refund eventually. But it was. I think the fee was like $15,000 or something like that.
Word.
For over contributing. Don't do it. Just one TFSA. Have one TFSA. Don't open it and put GISTs in or something like that. It should be, unless it's what's appropriate, but it really should be your longest term money, depending on your financial situation. Anyway, the best thing about it is by far flexibility. So while you do, for tax side, for growth, for investment purposes, you want it to be very long-term money, you can do what you want with it. You can take it out, put it in today, take it out tomorrow, and there's no penalties. Unlike with RRSPs, you get the contribution room back, so there's no long-term penalties. It's a great solution for putting money in and taking it out. One other warning: day trading. So you have tax-free investment growth, but day trading can be considered a income growth, like a not investment income, but business income, like personal income.
Yeah.
And if the CRA deem it to be that way and it consider it professional trading or whatever, then they can tax you on that accordingly.
On the growth. Okay. Yeah.
So something to keep in mind if you want to be day traders out there. And then the other thing I wanted to mention quickly was the estate planning side of it. So this is quite possibly one of the best uses of it, and I have a checklist of things that we'll go through it in my estate planning, what to do in like for estate planning when you know like your spouse is passing away or something, or your parents or something. So and this is on that list of maxing out the other spouse's TFSA even with debt could be one of the best things you do for that individual. So for instance, I'm I've got something wrong.
Like
I've
a terminal illness.
Terminal illness. As part of the planning process, what I will often do is open a line of credit or something. And then when I start to deteriorate, we'll make a large, maximize the TFSA contribution, my TFSA. And then on death, that TFSA rolls over to you. And now you have my TFSA plus all of your TFSA room.
Right. Oh, I feel like you've told me this before.
Yeah. So maybe let's say there's no investment growth and I just have $100,000 in there and that's all I could put in there. And that's what you could have. It means that suddenly I pass away and now you have $200,000 of room. You have $100,000 from me and $100,000 from you. Unused room does not pass over.
So if you have the full, you should always put the full amount in.
Yes.
That's why you said open the line of credit?
Yeah.
Okay. Because it's worth it. Max it out.
Worth it even with the interest cost. It's worth it long term. Because now let's say you get $1 million in life insurance. You can now take $200,000 of that. $100,000 you can pay off the line of credit. The other $100,000 of your room you can put in there. Now you have a $200,000 TFSA for the rest of your life that can grow. That is a lot of money, tax free over the course of your lifetime.
Yeah.
Okay. But you have to be named as a successor beneficiary. And here's something that this is often overhyped a little bit, but it isn't. You should be named as a spouse. You should be named as the successor of the account, not the beneficiary of the account.
Right.
So successor just means that they get the account. Beneficiary means that it's liquidated, then they get the account. But even if you miss that, there is a time frame. It's not that long. I think it's only like 60 days or something. Don't quote me on that. That you can, as the spouse, like I die, you can go to the CRA and say, hey, here's our documents. I was married to him. It should have been successor, and they will honor it.
Oh, that's nice.
Okay, so there is a little bit of leeway there.
But it's like, do you really want to be doing that when?
No, much better for you to just go and be named as a successor, and it's easy and it's so fast. I mean, I could pass away on a Monday, and it could be in your name by the Friday, right? It's very quick to pass over, so more than worth it to do it.
This is one of the situations where I really struggle to not understand it. Like, I understand that people struggle with talking about these things. It's emotional. You don't want to think about it, etc. But I just can't comprehend putting that above planning personally.
Above planning?
Because I'm like, I would rather put myself, if it happens, I would rather put myself in a position to have the least stressful experience I can have. That versus, do you know what I mean?
Oh, like, yeah, but because I work with these type of people.
Yeah, for sure, I get that.
I also, avoiding it also means that sometimes it isn't a problem, right? And especially when somebody is sick.
Yeah.
Then it can be a little bit harder, and that's where I always approach, like, I see you're a client and you're coming in and you tell me, because I'm often one of the first people to know about various health issues and stuff, and they'll say, hey, so we just got diagnosed with cancer or something. And I'm like, we talk about the prognosis, and I say to them, okay, like I really feel for you, etc. My job here is to make sure that you can focus on what you need to focus on, because you know that we've had the conversation and I'm focusing on everything else. So I'm going to ask some questions. I don't want you to feel like I'm being insensitive, but I do need to talk about this openly, and we need to review things.
Yeah.
Right. And oftentimes it gives them then the expectation. They already know deep down that we're going to have these type of conversations.
Yeah.
But because I don't want it to be insensitive when I start talking about
It's like, okay,
life after, and I'm talking about like funeral costs and like when's the last time I'm now reviewing the will and we're having that conversation. Just is this what you wanted? Do you need to go see a lawyer? Like, I'm having these harder conversations that may seem insensitive, but really, really important to have. And
no, I feel like people want.
No,
like,
absolutely.
You don't want it, but it's like you need it, and you are the perfect person. Like, I love that you address it.
Well, overwhelmingly, I get a positive response.
Yeah.
Never have I ever got a negative response, because it's the case of they want to leave my office knowing that, okay, I have a list of these 3 things that I need to get done. That's it. I know everything else is covered. I can now spend the time with the family, with everything else, because I know this stuff is taken care of and sorted. So just an important thing to do for the estate planning side of things. Mm-hmm. But no, I back to TFSAs. TFSAs are incredible. They're great, and there's almost no reason not to use them. Mm-hmm. Use them. They're very easy to access if you do qualify. Super, super, super easy. I'm trying to think if I didn't hit any points. You get the contribution room. The contribution keeps accruing every single year, so you get new contribution room. So January 1st, you can put in that new amount. You can transfer existing investments into the RRSP as contributions. So often what I'll do is, if we have maxed out contributions, we'll also often have a non-registered account, and I'll get the client to funnel their money, their extra money, they're not spending their net worth up money into that non-registered account. And then we'll do TFSA contributions at the beginning, the first week of January every year, just from that non-registered account. Yeah. And it saves them, having the conversation, etc., like coming in. It's just like, this is what we do. We keep it, don't have to worry about it. Something that irks me, that I use as an alarm bell to know that there's other issues, deeper issues, is when I see people like in retirement saving up for their RRSP, their TFSA contributions. So what will happen is they'll select an income. Let's say they have their pension here, this, that, and this. And then every year they will, like, or I'll hear of them coming, or they'll be new to me and they'll be like, oh, every year we just do our TFSA contributions. And it's like, okay, but that means that you've been then saving throughout the year. It means you have too much cash in your account.
Yeah.
Saving for this.
They're not investing regularly.
Yeah, it should be invested, and you should only be taking what you need. And that's it. You shouldn't really be saving in retirement. When you're relying on your investments to fund you, there shouldn't be a saving aspect to it. It's the money's there. You should be spending, and then we do TFSA contributions. Because then that means, does that make sense?
Yeah.
It just means, it says to me that there's a problem with the system that they're using to manage their cash flow. But
that makes sense.
Yeah.
Quick question before we sign off. If someone's just starting, doesn't have a TFSA, how would you recommend they go about it? Because like I said, you can just walk into any bank or credit union or whatever and open a TFSA. Does that matter? Like, does it matter where you open it?
Yeah, it does. So the issue is that when you're brand new opening a TFSA, what banks will do is they will open a regular TFSA that all you can have in it is GICs and cash. And people will not switch quick enough. Mm-hmm. So I would insist on opening a TFSA with somebody that can give you investments, like actual investment options. I honestly, when you're first starting, I don't really even care if it's like higher cost mutual funds or what, like they're not ideal by any chance, but it is definitely better. I would rather the habit of knowing, okay, this money is to be invested, than the money is just to be put there in a TFSA variable as you put $50 a month in there and you never touch it because you don't realize that you can touch it. It's like, it's
you
just
can
this
totally
account
tell.
floating floating there with a little bit of money in there, and it's like
You're not using
you're
it
not using it
appropriately.
properly. It's not invested properly. You're putting $50 in it, and you probably should just spend it because it's just going down in value. And it's just like it's this. TFSAs and RRSPs. You go talk to an account manager or like a personal banking representative, whatever they call them these days, and you go talk to them, and they'll be like, "Hey, we'll open you a TFSA and an RRSP. Start saving for retirement." Yeah. And in reality, it's like, no, you're not. You're losing money for retirement. Like, this is not the. And this is where it's like, do the easiest thing. Like, do the work up front.
Yeah.
Set a process. Set a system that actually works, so that 10 years time you come back and you're not like, oh yeah, I've saved $50,000 into my TFSA, and you're like, okay, but it's been sitting in a variable account earning 0.05.
So nice.
Great.
So now that 50 grand is actually worth 20 grand at this rate. Because wow.
Gotta get there. Yeah, exactly. So it's just start how you mean to go on, set it up properly. So you're right, brand new, like first savings, invest it properly. Don't
where
do
would
the
you
whole...
like give a few examples? Obviously, you're not showing bias, but like someone like you would be able to do it if you can't go to someone like you. Just give a few examples.
Because I work with households of a certain size, right? Like you have to have a certain amount of investable assets. So like all of the kids that are my clients, their kids and their family and stuff like that, I will do it for them. I'll help them with it. But really, yeah, you're just looking for somebody that. So for what can I use?
Like Wealth Symbol.
Wealth Symbol. Q Trade.
Quest Trade, is that?
That's one. Anything, honestly, anything. If you're going into a branch like this is the first time investing, I would say go sit down and talk to somebody about it, even if it's the more expensive stuff. But you'll get, if it's the first time, you'll probably get a lot out of it, just having that conversation. So like if you go to the credit union, any credit union, typically, then they work with a Visa. So that's our back office. And you would want to talk to somebody that can offer you mutual funds at the very minimum, right? If you do have like parents or something like that has sizable investments at like an IROC brokerage firm like us, take advantage of it, and maybe they can give you better pricing, right? Like it's like I can have clients that are paying significantly lower than I would charge. Like on the first $500,000, I charge 1.5%. Well, and on under $100,000, I'm not the right person. I'm not the right person to be starting a brand new account for you. I'm going to be way too expensive. Yep. So find somebody that can help you with the needs that
started.
That you're just getting started. You just need to.
Yeah, you're not looking at all the estate planning, tax planning, this, that, without.
You don't need it. You're 20 years old. Maybe there's some like tax planning you can do for like your RRSP withdrawals and stuff, but really your parents would have the RRSP, so they like their advisor should be able to be the one. Like I do it for my clients, right? So you just need to start, basically. Just you made a good point when we was doing the seg fund episode. You was like, well, at least they started. Like, yeah, I'm going on about fees, it being so expensive, and I'm like, you know what? Yeah, you're right. At least they started, because there's a lot of people that wouldn't even start. So granted, just know that once you get to even $10,000 in the TFSA, you should probably start looking at other options, and you should try to be reducing costs, etc. But to start, just anybody that can give you a basic mutual fund,
start there.
Start there, and make it like a credit union or one of the big 5 banks. Don't do it at like Primerica or something like that.
Oh yeah, I don't like those. I don't like those things.
Just stick with.
I get lots of LinkedIn messages from Primerica.
Well, they probably want you to become an advisor.
They do, yeah.
Yes.
I'm like
nuts. Anyway, that aside, you just need to start. You just need to start and get it invested, invest it ideally for the long term, so that you can kind of understand it. I do really like the idea of, as you're young, seeing the markets go up and down and going through the emotional highs and lows, because that will be much easier to do with $5,000 in the account than $500,000 in the account. And if you want to build wealth, you will have to be doing it with $500,000 in the account. So you just learn young, and that's the way that I would approach it. TFSAs are great for that.
Yeah.
Great for that. So anyway,
There you go.
we'll close this episode up. The next episode will be on Kalana, and Cease is actually going to be, she put together I was putting together the information and stuff for this one. So I'm interested to see what she comes up with.
I am also interested to see what I come up with.
There we go. And then the one after that is on our final episode of what we do. So we'll be talking about insurance and risk management. Another fun episode. Okay, perfect.
Perfect.
Bye.
You say see you in the next one.
Oh, see you in the next one.
Bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.